What's going on, guys, and welcome back to the next video in this series. Now before we get onto it, make sure to like and subscribe so you guys get notifications of the new videos we will release. There's a whole series coming out of this, and also if you haven't seen the first intro where we discussed the basic patterns, definitely go check that out now. Alright, but let's get into it. Now the rules of Elliott Wave. Elliott Wave has got a lot of rules that we need to follow, and it is a bit of a frustration, but the nice thing about these rules are they do help you with your trading a lot more, right? Okay, so Elliott Wave is a very, very structured sort of technical analysis with a lot of rules, but these rules help you really identify exactly in the market where you are, and helps you to prevent, taking trades that could potentially not be trend reversals, or taking trades that could, potentially give you a lot of money. And also it gives you an idea, it can give you a really good idea of saying, okay, well, I've taken a trade, it's reached a resistance, but chances are very high that it continue further higher, so I could potentially make a lot more profit from this thing. Okay, Elliott Wave, in my opinion, is a really good analysis that helps you to really extend your amount of profit you can take, and really help you to get as much out of the market as you possibly can. All right, there are a lot of indications that show in Elliott Wave that show you when the market's ready to reverse, and also when the market's ready to just continue flying in the direction of your trade. Okay, so let's dive into it. So we'll first focus on, now we do know from the first video we had our impulse waves and our motive waves and our corrective waves. We've got the main two different sort of motive waves. We've got an impulse and we've got our diagonals. So let's focus on the impulses first. We do know the first basic impulse structure is our 5-3-5 structure. So we've got 5 waves to the upside, which is wave 1, 3 to the down, 2, 3, 4, 5. All right, and we always know these consist of 5, 3, 5, 3, 5. Okay, so all we need to do is just count 5 waves, 3 waves, 5 waves, 3 waves, 5 waves. All right, so let's label them 1, 2, 3, 4, and 5. All right, now let's get into the basic structures of these. We also do know, like I said, we've got the 5 in here, 3 to the downside, 5 in here, 3 to the downside, 5 in here. Okay, basic structures. Now let's get on to rule number 1. Rule number 1 is wave 2 cannot go below the start of wave 1, obviously, because wave 1 is a trend setter. It sets the new trend. Okay, so obviously if we have this wave 2 that goes below the start of wave 1, so this is pretty much 0. All right, we've got 0, 1, 2, 3, 4, 5. If this goes into that territory, your wave is invalidated. So for example, if we've got, if we see 5 goes to the upside and we see a pullback that goes all the way to the downside, it breaks past this zone, we know, okay, well, we're possibly looking at something else. Let's recount our waves and see what's going on, because now we can't label this as wave 1 and wave 2. Okay, it's invalidated. It's pretty much the same when you have technical analysis. If you have technicals where you see, let's say you've got a market coming to the downside, and now we're seeing the market start to pull up. You're looking for that first retracement. Everyone, if you're a swing trader, you always know the first dip is the best time to buy, that first sort of pullback, and then you want to enter in the market as soon as you can for the move to the upside. Now, a lot of technical analysis will give you, say, you have to enter past as soon as we break that, which is fine, but your stop loss can be quite big, because sometimes we get a first initial move which is quite large, and we get a pullback that's rather large, and then we have to wait all the way for the market to go back up here before it breaks, and then we have to take a trade. Okay, so and then sometimes the market will retrace, and then it will start moving up, and then eventually you'll make some profit, but your stop loss is all the way down here, and you potentially could have missed this massive move, a lot of this massive move already, so your R&R could not be ideal. Okay, so that's the nice thing about Elliott Wave, because what we look for in that initial pullback is waves 1, 2, 3, 4, 5, and we know we have to get a 3 wave to the downside. 1, 2, 3. Now there are a couple of variants of this, but we'll get into those as we move on with this rules video. Okay, so we see 3 waves to the downside. We can also see we've got 5 waves in here, and we've got 5 waves in here. And now we know, okay, well, the market is ready to, we also got Fibonacci, what we talk about as well. We've also got our Fibonacci zones, and what we see is, okay, cool, the market has given us, 3, 4 signals to say, okay, this is the area where I'm going to return. So all we have to do is take a trade, let's take an entry as close as we can possibly here. As soon as we start seeing a little bit of movement to the upside, we can look to take a trade. stop loss just below that zone, and we, instead of waiting for the market to go all the way back to past the zone, we can enter nice and low here, super tight stop loss, which means we can, you know, have a bigger trade size, because the smaller our stop losses, the bigger our lot size can be, and we can take a marginally larger trade with the same amount of risk, but a much larger amount of profit. Okay, so that's kind of where Elliott Wave really comes in handy. All right, so let's move on to rule number 3. All right, sorry, rule number 2. We can't skip one. So rule number 2. Wave 4 cannot go into the territory of wave 1. Now this is for an impulse only. We'll talk about the diagonals when we get there, okay? So impulse only. And really, we don't really want to be trading diagonals because they're messy waves and there's an easy way to pick them up. But we'll talk about that, okay? So wave 4 cannot go in the territory of wave 1. So for example, if we see wave 1, wave 2, wave 3, obviously with our 5-wave structures inside, this wave 4 cannot come all the way back down into this zone, okay? That invalidates our wave 3 trade. If we see this wave 4 come all the way back down, we can say, okay, cool, well this, instead of labeling this a wave 1, 2, and 3, let's label it something else we know, which looks like this, okay? We can label it A, B, and C, okay? Now we know, okay, well, the market's in a corrective phase. Obviously this is an impulse on the smaller term time frame, but what we know is that the market's in a corrective phase, so chances are the market will probably continue to this point or even further, because we are in this corrective. Because we know when there's ABC, there was a 5-wave structure previous to this, you know, however big it was, and we do know after ABC, what do we see next? We see 5-wave structures to the downside. So chances are we could see 1, 2, 3, 4, 5, something like that, which gives us an indication. Instead of, you know, a potential head and shoulders trade that we see here, you know, people generally take, and they will take this maybe down all the way back down to here, or whatever the distance is from here to here, they'll take it down to. But we know, okay, if we see, you know, 5 waves coming down, we see 3 to the upside to match this head and shoulders, and we start to see 5 waves to the downside. We know, okay, cool, I've taken my trade, all the, you know, up here with this head and shoulders pattern. We can then see a 5-wave to the downside, we saw 5 waves to the upside. Now we can say, okay, well, let's wait for another corrective wave. If we see another corrective wave, we can see, okay, well, all I need to do now is move my stop loss to break even, or, you know, insert some profit, or maybe potentially close some profit, because we know we've now got wave ABC, we've got wave 1, 2, 3, right? So horrible 3, we've got wave 4, and what comes after wave 4? Easy, wave 5, and that's going to allow us to drain more out of the market instead of closing our position early and letting the market run a little bit extra more. So there's a nice, again, a nice potential for us using the rules of Elliott Wave, the second rule already, only 2 rules, and we already figured out a way to take out more of the market than we initially planned to with regular technical analysis. So that was also a nice rule to follow. Okay, and then another rule is, the third rule is wave 3, this one over here. Wave 3 can't be the shortest wave. It doesn't necessarily have to be the longest wave, but it can't be the shortest wave. Now what I mean by that is, if we have wave 1, which is fairly long, we have wave 3, wave 4, wave 5. This cannot exist, alright? We can't see 1, 2, 3, 4, and 5. This is not a proper wave count, okay? There's another way to count this wave, so let's have a look into this. Now, this is also having a bit of an issue for me, that a lot of people, you know, I've read a book recently, some technical analysis book. I'm not going to name the author or anything, or the book name, but it was a very well-known author and a very well-known book. And the guy talks about, you know, different technical analysis and teaching people different technical analysis. I found the first 2 chapters pretty handy, pretty helpful. But then when he got into the Elliott Wave structure of the book, I thought, man, you know, how can this guy's really just selling a book? And the issue I have with that, you know, I'm not banging on someone trying to teach people how to trade. My issue is someone teaching someone something wrong, okay? So if you're teaching someone the incorrect technique, potentially really damage their trading, which for me is really frustrating. Okay, so let's get on to the reason why, you know, we don't want to be looking at these fake things, and it's, you know, it's always difficult to trade with false information. All right, so what I saw in this book, the guy pretty much, he does structures like this where he says wave 1, 2, 3, 4, and 5, and he says, okay, well, the market's going to come reverse for a very big, you know, move to the downside, or what they say is, you know, we've got wave 1, 2, 3, 4, and then we've got wave 5 or something. You know, they just look for any sort of 5-wave structure in the direction of the market, which is really, really incorrect, because the issue with this is seeing this structure and knowing that our internal waves also consist of 5 waves. What we can see is we see, okay, well, yes, okay, we've got wave 1, you know, this is pretty simple, but this isn't quite right. Something's not right here. Now, if you follow the fake rules or the false rules, incorrect rules, you'll think, okay, well, I've seen 5 waves to the upside. Now what we're going to see is we're going to see a big, massive drop to the downside, which is wrong. All right, so let's have a look into why I say that. So the issue with this is, seeing this small third wave, we need to now that we know the proper rules to Elliott Wave, we need to know how we can properly count this. Okay, we do know that wave 3 can't be the shortest. All right, so we know, okay, well, maybe it is an extended third wave, which most of the time it generally is if we see a structure looking like this. So what we can instead label this is 1, 2, wave minor 1, minor 2, minor 3. And now we know, with our much better educated Elliott Wave knowledge, we know this market's not going to drop down. It'll give us a little correction. Okay, we see all these people now starting to sell because they learned this wrong technique. So they sell the market here, and us being patient, we know chances are this market's going to pull back a little bit, create our smaller minor wave 4, and then push up. Wave 5. All those little guys got stopped out. We're still in this, we know, okay, cool, we took a trade on wave 5, and we're seeing the market pull back to a bigger version. We see a bigger sort of pullback, and we know, okay, well, here comes wave 5. All right, so now instead of having this sort of 1, 2, 3, 4, 5, and then whatever this is, we now know, okay, we've got wave 1, wave 2, extended wave 3. So we see wave 1, 2, 3, 4, and 5, and now we know, okay, well, this market's not going to drop. Now it's going to drop, but the guy who decided to sell here is going, but I did it right. I counted 5 wave. What's going on? Why am I wrong? And the reason is because you need to follow the rules in Elliott Wave. Okay, so this is why it's so important to follow those rules. Okay, so let's hop over to the last sort of rule. Okay, the last rule of this impulse wave. Now, impulse wave, we know, is either a wave, is most of the time it's wave 3, but we also see it in wave 1, wave 3, and wave 5. Okay, so our impulse waves are in wave 1, 3, and 5, and also our wave A and our wave C. So we see it in wave A and wave C. Now, obviously, these, like I mentioned in the first one, these are the waves in the direction of the trend. All the black ones are the ones in the direction of the trend, because if you look on a lower term time frame, that's the uptrend, right? Terrible arrow again. That's the uptrend, and this is the a downtrend. Okay, so we know what we need to expect. So in an impulse wave, always has to consist of 5 waves, no matter what. An impulse wave is always 5 waves. Okay, so what we'll see is, because we know all these waves in the direction of the trend are impulse waves, we will see 5 waves to the upside, 5 waves to the upside, 5 waves to the upside. Okay, that's always the case, all right, with the impulse wave. Now let's have a look at this one, which is a normal zigzag pattern. We call this one to the downside. We call this a zigzag. We'll get more into. There are a couple of combinations of corrective waves. Okay, but we'll cover them, and we'll also teach you how to look out for not trading the wrong impulse wave. Okay, and then we know, obviously, with a zigzag, 1, 2, 3, 4, 5, 3 to the upside, we know 1, 2, 3, 4, 5. So that's the other rule. Impulse wave always consists of a 5-wave structure. Not your diagonals, okay? Your internal structure of a diagonal, not. But impulse waves always consists of a 5-wave structure. And that's the last rule for the impulse wave, okay? Now let's have a look at our diagonals. So diagonals are trends that are sort of waves that indicate weakness in the market or anticipation in the market. Okay, and the reason, the reason for that being is when we see impulse waves, like I mentioned in the first video, if you guys haven't watched it yet, is a diagonal kind of is either found in waves 1, wave. Let's write it down. So a diagonal is found in wave 1, wave 5, wave A, very rarely in wave A, but it is still found in wave. So I'll underline this because it's rarely found in wave A, and it's in wave C. So rarely found in wave C. All right. So it's rarely found in wave C. My mistake. So we see it very uncommonly found in wave C, but these are the waves that we always see diagonals show up in. Now there are two different variants of diagonals. We have our more common one, which we see most of the time, which is the contracting diagonal, all right, and we have our expanding diagonal, which we see as not too common. Now, an expanding diagonal only ever shows up in wave 1, so this one only ever shows up in wave 1, wave A, and extremely rarely, I've seen it maybe once, and I could have had a wrong wave count as well, wave C. All right, so very rarely, but most of the time we see it is in wave 1. Almost, I would say A is also fairly rare to see it in, but most of the time is wave A. Okay, so now that we know where we find them, let's have a look at these rules. Okay, we will never see a diagonal as a wave 3 ever. We'll never ever see a diagonal as a wave 3. A wave 3 is always an impulse wave. It's always that 5-wave structure, strong 5-wave structure to the upside. Always. It's never anything else. Okay, it's never a 3-wave structure, never a diagonal. Wave 3 is the money wave, and that's the wave we'll be trading, and that's what we'll be looking at throughout the series, is how to perfectly catch this wave 3 wave. So wave 3 is the only wave that only ever consists of this impulse wave. Okay? Now let's have a look for these. Let's have a look at the rules for these impulse waves, and a bit of an understanding to them as well. Okay, we'll have a look at a bit of getting to understand them and getting a bit of a better idea of what happens to them. All right, so let's have a look here. Okay, so what we see, we'll focus on the first ending diagonal. We'll see, or leading diagonal. We see them contracting, so we see them move to the upside down over here. Okay, so this is a very interesting wave, okay, because we know in technical analysis we label this wedge. Okay, they follow the same wave, but generally what this shows is there's a depletion in the market. So if you have, like, let's say a stochastic or any sort of indicator, you'll see that we've got the move to the upside, and here we've got a move to the downside. So we'll tend to see a bit of divergence in here, and this is the way the market is showing us it's tired, depleted, if it's towards the end of a wave, tired and depleted, and the market is sort of ready to start dropping off a cliff. All right, we see it slowly moving and then dropping off the cliff. Okay, now in the beginning of the wave, if we see it in, let's say, wave 1 or wave A, it can show anticipation or waiting for something. So we don't really use those stochastics there or any of those indicators, but generally what it does show is, we're seeing people that don't quite know what's going on. What are we doing? Is this market going to go? And then we start to see, the second wave struggle, or this wave struggle, because we know we've got wave 1, wave 2, we see it struggle, and then boom, wave 3 happens. Okay, so that's kind of where we see this whole structure. So it shows in the beginning of a trend, it shows anticipation. Okay, and at the end of a trend, it shows depletion. All right. Now, knowing that, we need to understand a bit of psychology for this wave as well. Okay, because like I mentioned, all we see on the chart, these charts, we do price, time, is literally mass psychology. It's people reacting on certain things. And a quick look into that, I will dive more into it later, but what we'll see is we see, people don't know what to do. We see people building up. We see hopefulness coming. And then we see, people taking their trades. We see people getting confused, don't know what's going on. We see the last hopefulness of people trying to get money back. And then we see people panicking because the market's never been this high, or it's very high. We see them panic, and people go, okay, well, maybe this is just a retracement for the market to go further higher. And then we see doubtfulness because we're hitting a resistance or support or whatever. And then we go, okay, no, this is not it. And then we have our complete structure. So we've got our waves 1, 2, 3, 4, 5, A, B, C. Okay, so that's kind of the basic psychology of the market, all right? And that kind of helps us understand sort of why these waves are structured, but all we really want to know is where they are and how do we count them. So let's get back to these rules, okay? Diagonals. Now, there are two different sort of main structures of the ending diagonal. We see, like I said, we've got this first one, 1, 2, 3, 4, 5, and we've got the other one, 1, 2, 3, 4, 5. Now, This one shows up a couple of times in different sort of formations, okay? Now we've got the first one that I'll be talking about will show up, like I said, in all the other waves, and this one will show up only in wave 1 and wave A. Only in wave 1 and wave A. And we'll talk about that now, why this structure generally shows up there, okay? So the first one, the most basic one we see, is a 3-3-3-3-3 structure. So what I mean by that is 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, okay? Now this gets a little bit complicated, but if we understand the psychology behind the market, I can explain, we can have a better idea of why is this motive wave not consist of, its internal waves not consist of 5-wave structures. I mean, it's a 5-wave structure, but why is it 3? Why are the moves the direction of the trend a 3-wave structure, okay? And this indicates, like I said, what this wave is. It's depletion in the market. It's people getting uncertain in the market, and that's generally what a correction is as well. So whenever we see a big move in the market, a correction is depletion in the market. It's uncertainty. People don't know. It's pretty much the market taking a break. And this is what's going on here. The market's getting smaller and smaller and smaller. People are uncertain in the market what's going on. So we see these 3-3-3-3-3 structures. And the reason why we see this in the other waves, generally speaking, we see this in wave 5 or wave C, is because the market is showing depletion of movement. Okay, so we're seeing this sort of curve action in the market, right? We're seeing the market slowing down. So this comes from, you know, like I said, it comes from the 5th wave, or, you know, the C wave. So we're seeing the market starting to slow down, and once we see this, we know, okay, cool, you know, the market has really showed us. We've seen our 5-wave structure to the upside, we've seen 3 waves to the downside, and we see this mess coming to the upside. And generally speaking, in normal technical analysis, we know generally if we see the market squeezing like this towards the end, and we have, if you do use indicators, and you're seeing, you know, that divergence as well, we know this market is super exhausted, very depleted, and generally what people like to trade as well, your basic technical analysis, when they see a wedge sort of forming, they take the trade and will take it only back to the start of this, okay? But now that we know, hold up, this is a wave 5, this is going to be a much bigger move. Now depending how we see the structure, yes, if the structure does this, and we see 5 waves inside here, we know, okay, well, yeah, it's the end of the move, let's get out of this before it turns around. But if we see sort of the, you know, the initial 5 waves coming down, 1, 2, 3, 4, 5, we know, okay, I'm not going to get out here because I know this 5-wave structure indicates it's a new trend, right? And we could see the market pull up. Now we're going to get everyone who knows only normal technical analysis to know, okay, we're going to take it to the start of this trade, get out here, we'll exit here because, you know, it's just a retracement. But us Elliotticians know 5 waves to the downside, 3 waves to the upside. What do we get? Another 5-wave structure to the downside, and we take a beautiful big ride all the way back down. All right. Now I talk a lot about trading, so you guys say, but where do I enter? Where do I put my stop loss? We'll get to that as we get into the market. I just want to teach you guys the rules and everything. So like I said, we'll be focusing on the rules here today. For those experienced ones who think, oh, you know, I already know this, that's fine. Like I said, this video is going to be for the beginners and for the advanced as well. The advanced will be coming later, but we do need to learn the basics as well. And it's also, if you're a bit rusty, this is a good video for YouTube. All right, so that's the basic structure. This first one needs to be 3, 3, 3, 3, 3, showing that depletion in the market. Now let's move on to the next one. Like I said, there are 2 different types of contracting ones. So we see our initial one, which was the all 3-wave structures, and we see the next one, which is the 5 structure. 1, 2, 3, 5. A, B, C, 1, 2, 3, 4, 5, A, B, C, 1, 2, 3, 4, 5. Okay, and now we know, all right, well, like I said, this one only shows up in waves 1 and wave A. And the reason for this being, this is the beginning of a trend. So it doesn't show depletion like the other one with the 3 waves. It doesn't show that depletion in the market and the market's getting exhausted. This is just showing uncertainty because we see there is strength being picked up into the market. We see a lot of strength to the upside, quick burst, beautiful strength move. We see a bit of uncertainty to the downside. The market's still uncertain. It doesn't quite know what it wants. The traders don't quite know what it wants. The battle's still kind of conflicting between the 2 buyers and sellers. We see a big another push up, and people start to realize, okay, hold up, big push up, and then we start to see this struggle to the downside. So this is the indication that the market is uncertain, but it's settling on I'm ready to go up or I'm ready to reverse the trend. Okay, and that's generally why we see these 5-wave structures in this market. So pretty basic and simple. So if we see this structure and we don't really know and you don't know the history to the back, that's the beautiful thing about Elliott Wave, is we don't necessarily always have to look at that previous history. All right, it's always good to look at it. I'm not going to say don't look at it, because it's good to have an idea of where things are in the market. But if you don't, and we see this and we see, hold up, there are not 3 waves in here, there are 5 waves in these waves. We know, okay, well, this isn't going to be a trend reversal, it's rather just going to be the beginning of a new trend. So we know, all right, well, let's wait for this pullback, whatever this wave structure looks like, a 3-wave to the downside, a corrective wave to the downside. We know, okay, well, cool, it's pulled back, where we see people who see the structure go, oh, it's going to be a break. If I break to the downside, I'm going to take a sell and take it all the way back down here. Now we know, right, the rule of wave 1, we can't have wave 2 enter the territory below the start of wave 1. So we can't, people are going to say, okay, I'll take a trade all the way back down here, and the trade never reaches it. But we know, okay, well, we've had this structure, we've counted the internal waves, we know, all right, this is going to be a retest, let's wait for this structure to finish. Now we can take a buy, and we can let the market continue further higher. We have that advantage. We've got the edge above the other traders. All right. So let's have a quick look now. These 2 structures I've got, like I said, they're different internal structures, but they've got a couple of rules that they both have to follow. Okay. So let's have a quick look at those. Quick rules. So we've got waves 1, 2, 3, 4, and wave 5. All right. Now, this has to follow a certain type of rules. Wave 1, wave 2, wave 3, 4, and 5, for us to validate this, okay? Wave 1, it has to be the longest wave. It has to be the biggest and baddest wave out of all the other waves, all right? If you guys get the idea, it has to be the biggest wave out of all the waves, all the waves in the direction of the trend, okay? Wave 2 has to be the biggest corrective wave, so wave 2 has to be bigger than wave 4. Wave 3 has to be smaller than wave 1, but remember, wave 3 can't be the shortest wave. So wave 3 has to be shorter than wave 1, and wave 5 has to be the shortest. So generally, to make it a bit easier, speaking a bit easier, each wave has to be decreasing in size, all right? So wave 5 can't be longer than wave 3 can't be longer than wave 1, wave 4 can't be longer than wave 2, and that goes for both the things. Okay, that goes for both patterns. So we've got the one that goes 3 waves to the upside, 3 to the upside, 3 to the upside, and also for the one with 5, 3, 5, 3, 5. All right, same structure. They both have to follow this rule. All right, they both have to have this size proportion structure. Now the other rule is wave 4. This is where that one we talked about. The wave 4 has to come into the territory. This used to be a rule, but let's talk about this now, okay? There was a rule where wave 4 has to go into the territory of wave 1 or close to the territory of wave 1. Now, I remember reading the Elliott Wave book, and they said there was one instance of where wave 4 didn't quite go into the territory of wave 1. Now, they said this reason for it was a futures chart, and futures charts don't always follow the exact same rules of Elliott Wave. Now, remember when they spoke about this, this was in between 1940 to 1950, all right? So this was a very long time ago when they said this sort of happened. Maybe it was a little bit older than that, but it was way before our time. Okay, well, depends, way before the time of real forex trading happened, okay? Now, saying that, we need to understand, okay, well, the stock market was, like I said in the beginning of this video, of this series, the stock market had a small niche of people trading, all right? They had the people who already had a lot of money and had money understanding, but now we've got a general bunch. Whoever's got $50 in their account can be called a trader, so they influence the market. So this rule is going to be very hard to say, okay, all the time, if I don't see this is invalid. So we need to understand that the market is adapting, and we need to adapt to it as well. All right. There are still a couple of things like wave 2 that can't go into the territory of wave 0 because a new trend can't start that way. Okay, so that's one rule where I'd say as long as this comes marginally close to this wave 1, we should be fine. All right, we don't want to see this coming very close to sort of this structure, and in the end of it, it doesn't really matter, because if we see, for example, if we see a 5-wave structure to the upside, 3 to the downside, 5 to the upside, 3 to the downside, 5 to the upside, if this one doesn't come into the territory of this one, that's fine. It's just a regular impulse wave structure with a bit of a bigger retracement in wave 4, all right? Okay, but if it's a 3-3-3 structure, we generally want to see this one come fairly close. As long as we see this come fairly close to this area, we're fine. And as long as we sort of have this sort of pattern and we follow the other rules, the wave 1 has to be the biggest, wave 3 has to be the smaller than wave 1, and wave 5 has to be smaller than wave 3, and so on, then we know, okay, as long as we see this 5 structure to the upside, we know, and we see this general structure, the market has already given us an idea of where it wants to go. All right, so that's all that really matters. So this is, I would say, is more of a guideline than a rule, a set rule, because the market, like I said, is adapting. There's a lot of influence. And the other thing is, because they talked about how it was the futures chart, it doesn't quite follow the exact charts. We need to understand that all different brokers have different liquidity providers. So we'll generally see the market follow the same trend with all brokers. They all follow the same, more or less the same structure, but there will be slight, small differences inside of the charts, okay, because they've all got different liquidity providers, and these liquidity providers all have their different feeds. So we need to understand that a little bit as well. It's not just one big general market. I mean, there are $5 trillion plus a day going through this market. So, I mean, you have to have one massive liquidity pool to be able to support all that, all right? So it's just unrealistic, and we need to understand the situation that Forex trading is in. Now, that's why it gets quite fairly difficult to count Elliott Wave and Forex, but like I said, I'm making this entire video to help you guys use it better in the market. And also those indicators, if you really do struggle, the indicators will make it a hell of a lot easier for you to look at Elliott Wave, right? So that's the other rules to this sort of structure. Okay, now let's move on to the expanding diagonal, which is our next one we'll be looking at now. The expanding diagonal also shows depletion or anticipation in the market. All right, so let's have a quick look. So expanding 1, 2, 3, 4, 5. We see this sort of structure in the market now. Generally speaking, this one doesn't have a variant like the other one. It doesn't have 5, 3, 5. It's always 3, 3, 3, 3, 3 in all the waves. Okay, so we know it's going to be already a lot easier. And like I said, this one only shows up in wave A or wave 1. All right, this shows a lot of anticipation and a lot of explosion. There was one instance in the book where they saw this in wave 5, but it ended up being the wrong count. So I don't know why they even put it there, but it was once recorded, but it could have been counted a whole lot different. Okay, now let's have a look at understanding this wave, knowing it can be wave 1 or wave A. So why does it show up in wave 1, in wave A? What we see, the psychology behind this, is we see a burst to the upside, we see uncertainty, we see a pullback, we see you know the first sort of low new high, the lower high, right? The higher low. Sorry, man, words are struggling today. Lower high and high low. Sorry, and we see a next big push-ups. We know, okay, well, there's something happening here. There's a lot of anticipation in this market. There's a lot of momentum being started to kick into this wave. We see a pullback down, a massive pullback down to find support. Okay, and then we see this big burst to the upside, massive push to the upside. And what we see as well is we see this expanding structure. Okay, now a lot of people will generally try and trade this a certain type of way. So what they'll do is they'll try and trade it from here to here, okay, which is not wrong, it's perfectly fine, and they'll try to trade it from here to here, and that's their trade. Okay, but we know as Elliotticians there is much more to this trade than what we just have in these confined 2 lines. All right, reason for this being is because we know, okay, cool, we've now got wave 1, we've got wave 2, and we know wave 3 has now started. So instead of closing our trade when we reach that line up there, we know, okay, the market could retrace a little bit and continue further higher to complete that overall wave 3. So we know instead of waiting, taking a little bit of profit, we can make much more. So Elliott Wave is really for the person who doesn't have time to sit in front of the market, waste their life away, or panic with scalping. It's really an in-depth nice swing trading strategy. And this is, this is the reason for it, because we know, okay, we know not to get out too early on the market. We know there's much more to this trade, all right? So now let's have a look at the basic rules of this one as well. Okay, now we already know all the waves are consistent of wave 3. We know it shows up in wave 1 and wave A. We do know it's anticipation in the market. So let's have a look at the fundamental rules in this sort of structure. So again, quickly label it 1, 2, 3, 4, 5. We have these rules, okay? Always must consist of 3 wave structures. We've covered that now. Now, the difference from this to the other one is kind of flipped around, right? So wave 1 has to be the shortest of the movements in the direction of the trend. Wave 3, we know, can't be the shortest, but it also doesn't have to be the longest. So we know wave 3 has to be bigger than wave 1. And wave 5 has to be the longest wave out of all the moves to the upside, all right? And the other thing we do know is also wave 2 has to be the shortest corrective wave. And wave 4 has to be longer than wave 2. So pretty easy, pretty simple. We also get back down to wave 1's territory, where we dip into that, and that's pretty much an easy, basic rule. All right. Now they follow the same psychological structure as the contracting one. It shows the market's ready to. It's not quite sure, but it's ready to go into the direction like I showed you guys previously. All right. So that's pretty much the basics of the motive wave. Now the motive waves are the waves we want to trade. Okay. Now corrective wave, correction waves are a bit of a difficult one to look into, okay? So let's start off with the basic corrective wave structures and the ones we want to be trading, okay? So like I said, we've got the basic, the one I've been showing you the whole time is the 3-wave structure, A, B, C. Now you'll hear me talk about 3-wave structures all the time. A 3-wave structure is any corrective wave structure, and we'll talk about that a bit more. There's one exception to a 3-wave structure, but we'll dive into this, okay? So we've got a zigzag. Very creative. They were very creative in the names of their labelling. So we've got a zigzag, we've got a flat, and we have a triangle. Very, very creative. I assume you guys can see where the name flat came from. They were very creative in their naming, which I like. And we have a triangle. Okay, these are the structures we need to be that we look. Okay, now to understand, there is a combination as well. A combination combo, which is any 1, 2, or 3 of these structures put together. All right, but we'll look into that. It's a very complicated structure, but we don't really need to know too much of it to be able to trade Elliott Wave. All we need to know are the basics of it, which really does help. And that's why this indicator that I'll show you guys at the end of the series also has, will help us identify whether we're in a corrective structure or an impulse structure. And that will really help you identify, or really having to not have to go into the depths of these waves and count them, okay? Because once we start entering into combinations, or even sometimes triangles, it just gets a bit of a hellish place to be in the market, and we just don't want to be there at all. And this indicator helps you to sit it through and just wait up, or know when to take a trade into that structure. All right. So let's have a look at. We'll have a look at zigzags, then flats, and then triangles, and we'll cover some combinations as well. So let's start off with our zigzag. So as we know, if we look to the opposite side of the trend, if we look on a smaller term time frame, a zigzag is a move in the direction of the trend. Okay, now this is obviously a bearish trend, so the market's moving to the downside. So we know this market consists of 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. All right. This helps us identify once we see a 5-wave structure to the upside. We've seen that 5-wave structure. We see that 5-wave structure to the downside. We know, okay, cool. We have now eventually started to reverse the trend. We see going to be an ABC, and we know once we see a 5-wave structure, which is the only corrective wave where it's got a 5-wave structure in the beginning, we know exactly it's going to be a zigzag. All right. So to have a look at the rules of the zigzag, we know, like I said, this has to be a 5-wave structure. Now the beginning, like I mentioned with that diagonal, that can be anything from an impulse wave to a leading diagonal, or to a contracting diagonal. Okay, so it could be any one of these three structures inside of this wave. All right, this next one, most of the time it is a impulse wave. That's why wave C is the wave we want to trade in the corrective phase. If you wanted to trade on a smaller time frame, wave C is the wave that's most of the time is this. Sometimes it's a ending diagonal, very rarely it is, okay? But most of the time it's this beautiful structure to the downside when we have a zigzag, and that's the reason, that's the trade we want to take, okay? So that's kind of the basic easy rules for this. I'll show you a little bit of a guideline as well to it, which will help you identify when a zigzag is ready to be over. So a guideline for zigzag, the best way to figure out when they're going to be over, obviously, is our first initial structure. Okay, we see 5 waves to the downside. We can see 5 waves inside here. We know, okay, this wave is ready to be finished, and we'll go to the upside. But the other way we can look at it is this wave. Let's call this as 1. And so these two waves are the same length, more or less the same length, okay? We've got a bit of Fibonacci in here as well. We'll talk about, because this one can be a Fibonacci ratio, this one. But most of the time, it is 1-to-1 for these two waves, okay? So that's a pretty easy way to pick it up. So zigzags, very basic, very simple waves. Now, the other rule is, in a zigzag, we need to have this movement to the downside, this zigzag pattern. So we know, let's quickly label it A, B, C. We know that wave B cannot go into the territory of that zero. We can't go beyond there, all right? We can't push into there because that'll invalidate our count. So it's pretty much a zigzag pretty much has the same start as a wave 1. 1, 2, 3, okay? And it pretty much has the same start, okay? Very similar. We can't go into, well, past the ending, the beginning of that structure, all right? If we do that, we need to look at our count here because we definitely messed something up, all right? So that's the rules for a zigzag. Fairly easy, very simple. Now let's get on to a little bit more complicated ones. We'll look at the flat and how we can identify whether the corrective wave is going to be a flat, okay? And and then at the end of it, we'll talk about a couple of guidelines where we can figure out whether we're going to expect a flat before it even starts to happen, or whether we can expect a zigzag before it even starts to happen, all right? So, when we see a flat structure, okay, we had the market come from the downside, all right? Sorry, we had an uptrend, and this is our flat corrective. Now, a flat wave, how do we identify if this wave is going to be a flat instead of a zigzag? Let's say we've got wave 3. How do we know what wave structure this is going to be? If we see this structure come down with 1, 2, 3 waves. Now, 3 waves can be any corrective wave except for a triangle. We know, okay, well, this is going to be a flat correction. And the next wave we see, so we've got wave A, wave B. Wave B always has to be a corrective wave no matter what, all right? It has to be 1, 2, 3 waves to the upside. Now we know, okay, well, we've got 3 waves to the upside. We're starting to see a new lower high, a higher low being formed, all right? A lower high being formed. We know, okay, cool. Chances are this is not our complete zigzag structure. We have a 3 wave to the upside. We see it reject around this area, and now we're pushing to the downside. Now we know, okay, cool. We'll take this trade 1, 2, 3, 4, and 5. Okay, now we've got this beautiful 5 waves trade to the downside, targets to the bottom below there. Very easy trade, very simple. Okay, these are the rules. So this must be a 3 wave, this must be a 3 wave, and this has to be a 5 wave structure. This is why wave C for us in a corrective wave, except for a triangle, is the wave we want to be trading if we want to trade on the smaller term time frames, all right? So this is the wave we're going to be trading. So if you're looking at the daily time frame, this could be a good trade to the downside, maybe on the 4-hourly or the hourly. Okay, even 30-minute. You know, if you want to look at 30-minute potential entries, we can always trade a big 30-minute trade as well. But anything on the lower term time frames, just be aware, guys. I always tell this to my students, and also, BlackBull markets when I used to be here as well. The thing I always used to tell people is it's a bit of an issue with trading. Okay, there's a little bit of an issue. Let me explain this to you. So, the lower we go on our time frames, so the lower we start going onto a time frame, the more trades we'll have, the more entries we'll have and signals we have, but the worse quality they'll be. So our entries go up and our quality goes down. So that's self-explanatory. You can potentially be over trading and taking silly trades. And now the higher you go with your time frame, the less trades you'll take, but the better quality they'll be. Okay. Now this comes to a bit of an issue, all right? Because I mean, there's only so much higher where you can go. Because the issue with forex trading is we have something called swap. All right. The swap is generated, every broker has it because it's a central bank's, central bank charging interest rate for holding a position overnight. Now the issue with this is obviously the longer you hold a trade, the higher your time frame is, right? The higher time frame you have, the longer you'll be holding a trade and the more swap you'll accumulate, okay? And obviously as a trader, you don't want to be taking a trade once every month. It's just going to why? So you need to be able to find your niche. My niche that I like to trade in is I like to do my analysis on the weekly to the daily time frame, and I like to take my entries on the 4 hourly and the hourly, mostly the hourly, but yes, I include the 4 hourly on my entries as well. So this is I don't even look at anything past the 30 minute because I see myself as a swing trader, and I like to hold trades for a couple of days. On rare occasions, I'll hold it for a week or more. But most of the time, my trades are being held for 2-3 days, or something like I said, sometimes a week as well. Okay, I generally don't like holding positions over weekends, especially if they're close to my entry point, because you could get slipped on the Monday morning open. All right, so that's just one little thing that I like to add in there. But let's get back to Elliott Wave. So we understand the structure of a flat. So that was the flat we looked at. Let's look at a structure called the triangle. So a triangle is we need to understand there are, as we know, in general, there are phases in the market. We've got our phase that goes with the trend, we've got our against the trend markets, and we have our consolidating markets, all right? And that is exactly what a flat and a triangle is, especially a triangle. A triangle is just going to take up time on your chart. That's all it is. We just need to know when to enter, but we'll talk about that. So a triangle will look something like this. So we've got waves A, B, C, D, and E. That's our triangle. And obviously triangle with the Elliott Wave having their creative names, there's the reason for it being called. Now the structure of this triangle, this is the only one where wave C in a corrective wave is a 3-wave. So every single wave inside of a triangle is a 3-wave structure. Okay, this is our wave. Now the other rule is, let's label it as well before we get ahead of ourselves. Okay, the other rule is rule 2 of the triangle is wave C can't go below the start or the end of wave 1 or the start of wave B, and similar to wave E, can't go below the end of wave C. And now we have wave D can't go above the end of wave B, all right? But there is an exception to this as well. So not an exception, there's another one we need to be aware of. So we have a triangle, which is called a running triangle, okay? The running triangle can come down, it can come all the way back up past the initial wave we had it, and then it can come back down. But the rest of the time, the triangle has to follow the rules. So we can have it like A, B, C, D, and E. As long as these don't interrupt each other and these don't interrupt each other, all right? That's all we care about. The labeled waves, as long as they don't interrupt each other, that's perfectly fine. And again, we have a similar structure. All right, that is the basic structure of the triangle. Now, like I said, we'll be looking at trading into the, how to trade these Elliott Wave moves as well, but you guys can see with the rules being already followed, we know where to start putting our stop losses and when we can enter into the market, or we can look to start entering to the market, because there are certain places where the market's not allowed to go if our wave count is correct. All right. Now, we're not always going to be 100% correct. I'm not 100% correct either. We need to understand we will be wrong in some cases. The market can surprise us, and we just need to look at a bit of a different way to do our wave counts. Okay. So what are the other alternatives? As any technical analysis, you see something happens where you go, okay, well, now it's not this, it is something else, right? And this is why I said these indicators that I will be talking about towards the end of the video will show you guys how to identify this to a better idea, to maybe bring that percentage up a bit higher, the accuracy percentage, right? So that's the basic rules for a triangle. Okay, and then we'll do a bit of a collective rule. So now let's have a look at our three structures again, our three corrective. Actually, let's have a quick look at the combination. Now, combinations are a horrendous thing. I'll quickly cover them, but there's so much I can say about a combination because they don't follow rules, they follow guidelines, and I could probably take up 3 hours just talking about combinations, but I won't because it's not necessary. We don't need to understand these combinations. There's only one reason we need to understand it, and we'll get to that now. So a combination can be of any sort of structure to the upside, or in the direction of the trend. So this can be any sort of structure, right? Oops. Okay, so we have got a zigzag, flat, and a triangle. All right. So this is sort of the combination. This combination can be any three of these in any sort of assortment. This is what we call a combination. Okay. Now it gets very complicated, but all we need to understand about is a combination is there's a sideways move in the market, and we can use those indicators I'll be talking about later to identify when we can look to start entering this trade, regardless of the combination, whether it's a flat, a triangle, whether it's a triangle, a flat, or a zigzag, or any sort of combination. We can identify when we need to finish this. So this is a combination. Okay. There are other ones as well that follow guidelines. We have a 333 and a 33. Okay. So this is generally found in the zigzag pattern. All right. So we have this in a zigzag. So if we've got a zigzag that comes to the downside, and we have, we think, okay, cool, this wave is done, this marker is done, we see now 3 waves to the upside, and then we see a break, we go, hold up, something's not right here. This is not a flat because, it can't be. This is also not a triangle because, it doesn't follow the rules because I've now gone below this. What can this be? This is called a double zigzag. We can do this one more time, or we can go up and down again, but this is called a double zigzag. They're not impulse waves. They won't be found in your wave 1, 2, 1, 3, or 5. They'll be found in your corrective wave. So we can see them in wave 4, and we can see them in wave 2. Okay, so what they are, they're just double zigzags that form in the market. Now they can be quite nice because if you happen to catch a wave C of this structure, and you see another 3-wave structure to the upside and now down again, okay, cool. Well, now I can potentially capture another wave C. So now you've just got 2 opportunities to take a trade if you missed one. That's all it gives you, really. So that's pretty much the basics of the double zigzag or triple zigzag. Like I said, if it does it 3 times, we can follow it again. Now the labeling for this is we have W, X, and Y. Okay. So in a triple zigzag, double zigzag, sorry, we've got W, X, Y. This is where Elliott, the Elliott Wave guys who found it was a little bit, were a little bit confused about the labeling because I don't know why they didn't, start off with something else, but I'll show you now. So we can have 1, 2, 3 to the downside up, 1, 2, 3 to the downside up. Okay, and how they would label this one is they would have a W, X, Y, double X, Z. Okay, the labeling doesn't really matter. I mean, unless you want to post your chart, that's the labeling for it. So if you guys want to take a screenshot, that's the labeling for the double zigzag. All right, that's pretty basic. The same labeling also goes for a 333. All right, that combination we talked about before, same labeling goes for it as well. But that's the basic. What we have is 3 up. Three against the trend. 3, 3, 3, 3. That's about it. Okay, pretty basic, pretty simple. All right, now let's get back to the 3 main patterns that we were talking about. All right, these 3 main patterns. So a double zigzag is we'll just put it with a zigzag as well. It's the same thing. All right, so we'll put them alongside each other. Now we've got our 3 patterns. We've got a zigzag, we've got a flat, and we've got our triangle. All right. Now where do these waves show up? They show up in our corrective phases, but they also give us a bit of a hint where we are in the market. Now, as an Elliott Wave trader, I look for this one is the first one I try and spot when I'm looking at the chart. Okay, now these are the rules for these. The zigzag can show up in wave 2 and wave 4, same for this, and wave B. Same for this one as well, can show up in these 3 waves as well, but the triangle can only show up in wave 4 and wave B. This already gives us an indication. If we just look at the chart and we see a triangle, we know we are pretty much a triangle gives us that last push in the direction of the market, and we could reverse, right? So we can see wave C or wave 5, and we know the market's going to come back down. So a triangle is a very good indication that the market is ready to take its last breath before it comes back down, right? Or dives back down, right? That's a nice amount of triangle, okay? So that's where we pick it up. Now, the other thing we need to understand as well is this one can be a bit confusing. So if we see, generally what we see in the market is we see what we call alterations. So we see two different types of patterns. So let's go back to our basics, to our waves 1, wave 2, wave 3, wave 4, and wave 5, all right? Now, these 2 waves generally alternate. They alternate between, sharp and sideways patterns. So what we'll see, remember, wave 2 can't be a triangle. So if we see a triangle before this happens, if we see a triangle here, we know, okay, it's probably ABC, or if we look back down more, this could be a 3, 4, 5 wave, all right? So that we just need to be aware of that. But if we see this wave being a sharp corrective wave, we call a zigzag a sharp corrective wave, we know wave 4, chances are very high that wave 4 is either going to be a flat or it's going to be a triangle. Okay, we know that because this is the guideline. Now, it's not always there, but it is a guideline that helps us identify where we are in the market. Now, similar thing goes for if we see a flat in this side of the market. So if we see wave 2 turns into a flat, we know, okay, chances are wave 4 probably won't be a triangle, it probably won't be a flat, but we'll probably see a sharp correction in the market. And this helps us anticipate to what we can look for, because if we start to see a move to the downside, chances are, and we start to see a move back up, chances are we'll probably break this low and then go for the upside, So it gives us just a bit of a better idea of where we are in the market. So if we see, for example, we counted our waves down here, and we see, okay, well, we've got wave 1, wave 2, we see, okay, cool, it's a flat, we can expect, don't panic, because we could rather see a very strong, quick, sharp move in this wave 4. Don't panic, because we just know it's just a zigzag upcoming and a move to the upside, which is quite nice. Now, what I've found as well, let's draw a bit of a realistic pattern. So those are the rules of these structures, okay? And the other thing, now like I said, let us quickly have a quick look at some things that can get a little bit confusing, because obviously, Elliott Wave can surprise us. Well, not surprise us, but it can make sense of market fluff, I like to call it, where we just see a lot of sporadic moves in the market. So I'm going to try and draw a fairly realistic structure of Elliott Wave, and then we can have a look at, different sort of structures. Okay, so let's have a look at our basic. We've got 1, 2, 3, 4, 5. We've got our wave 1. We see wave 2 is a sharp wave to the downside. Great. We've got wave 1, 2, 3, 4, 5. And we see, okay, well, we've got a sharp wave. We can maybe expect like a zigzag or a triangle, for example. So we just call a flat and a flat or a triangle, for example. And then we've got wave 1, 2, 3, 4, 5. Okay. So that's kind of a realistic sort of approach into the market. And obviously, these will have their internal waves as well. I'm not going to draw them all, but you can see the more I draw these internal waves, the more it starts to look sort of like a real life market. All right. So let me quickly draw it actually, just so you guys can have an idea. Alright, so you can see it does start to look like what we see on the charts. Alright, so the more we look at it, and the more we always see these little internal structures of these waves coming down, the more we start to see, wow, this is really starting to look like the charts. Okay, and it starts to look kind of similar, doesn't it? Okay, but now the one thing is, so that's kind of the perfect situation in the market. Now, the market won't always give us the perfect situation that we look for. Now let me explain what I'll be looking for. So I'm going to draw a chart, and you guys are going to get an idea of this something as well. Okay, so let's have a look at this. Okay, so that is kind of an interesting look at what we see in the market. Obviously, these things have all got their internal waves, but we're starting to see this sort of structure. It looks quite messy. We can't quite understand what's going on. So let's try and get a bit of a better idea of what we're really looking at here. And this is where Elliott Wave comes in handy, right? Once you start having a look for things we can see, let's look for the thing I look for the most, a triangle. Can we see a triangle on this chart? Yes, I can see a triangle here. And now we know, okay, well, this is either going to be a wave 4 or it's going to be a wave B. All right. Now let's have a look at the structures beforehand. Okay, we can see a bit of some sort of hiccup here. Okay, well, let's have a look and see. We can see counting back down from this. We see we've got we've got a 5-wave structure over here. One, what we have, we've got wave 3. We've got a 4. We've also got a wave 2, and we've got a wave 1. Okay, so now we know. All right. Well, this is most likely a 4-wave. We can take that away. We know it's a 4-wave structure. Okay. We know this is going to be a wave 5 because we know it's a 4-wave structure, and we know somewhere in here is a wave 1. So let's try and count this wave 1. So we see 1, 2, 3, 4, 5. Okay, cool. We see a 5-wave structure. We can label this one as, let me label it a little bit differently. Yes, sorry, this is over there. So we can call this a 3-wave, right? So 3, we know that's wave 3. We can say, okay, well, this is wave 4, all right? And now we can see we've got a 5-wave structure in here. We have got wave 1, all right? Now let's have a try and make up a look at this. Well, we can clearly see it's a sideways correction. We unfortunately didn't follow the alteration or the difference between the corrective waves. So we know we've got wave A, we've got wave B, and we've got wave C. So we know, cool, there is our second wave. It didn't come into the territory of our wave 1. That's great. Wave 4 didn't come into the territory of that bottom over there. These rules are being followed. We see we're seeing the market start to deplete to the upside. We see it's a wedge. We know we can see we've got wave 1, 2, 3, 4, and wave 5, and we know there's our structure, there's our 5-wave structure, and that is pretty much exactly how I break down my Elliott Wave analysis when I look at my charts. Alright, so these are the basics of things. Now let's have a quick look before we dive into the rest of it. I just want to show you guys through. We will talk more about it, but I want to talk to you guys a bit about this 3rd wave before we really dive into the Fibonacci side of things. So let's have a quick look at this 3rd wave. So the 3rd wave, like I said, is our bread wave. This is the wave where we make our money as traders. All right, because like I said, the psychology behind the 3rd wave. We see the wave 1 as now the direction of the trend. We see the slowing coming down. We see the anticipation. We see hopefulness kick in. We see it spike, and we see the big run, and we see then we can see sort of see this sort of structure. So if you're looking to see, like I just showed you guys, if we're trying to see where is this triangle, I can't see a triangle on this wave, what we want to look for is the biggest wave there is. If you go look at any chart, the biggest, strongest wave generally is number 3, is wave 3, okay? So as soon as we see that, we can go, okay, cool, I know chances are this is fairly a 3rd wave, and now we can start breaking down the rest of our market, okay? Now, proportion-wise, the rules of Elliott Wave state that, or the guidelines of Elliott Wave state that these 3 impulse waves, 1, 2, 3, 4, 5, waves 1, wave 3, wave 5 are generally more or less the same size. But in actual reality, not always, okay, most of the time, that obviously because the market, it's not always going to give you a perfect, beautiful structure. Wave 3 is equal to wave 1. So if you times wave 1 by, this is getting a bit complicated, we'll talk into Fibonacci, but if you guys know Fibonacci, if you times wave 1 by 1.68, 61 point, yeah, we will see, 1.68, we will see that the market is this, wave 3 as that much of wave 1, okay? So generally we see wave 3 being the longest wave in general, alright? We generally see wave 1 being the longest wave in general, okay? And that is the easiest way to pick it up. So if you can't see a triangle, if you look on the chart and you see some candles that are, massive, strong, big candles to the upside, we generally know, okay, well, we're probably looking at wave 3. Easy. Pretty plain, pretty simple, guys. That is it for the rules of Elliott Wave and the guidelines of the Elliott Wave. So, hope you guys enjoyed it. See you next video. Make sure to subscribe to the channel for the next videos coming up. There's a lot of cool content coming, guys. Thanks so much for watching. Stay tuned. Trade safe.